Hello, this is Dave, and welcome to Equity Story. And obviously, this is just general share advice and not personal advice. Now, Wolf, just having a quick look around, obviously, the markets, and this is the important thing. The ASX is looking pretty sick, and down she goes. She's broken trend. If it looks like this by the end of the week, yeah, we could be going a lot lower. If you look at the Dow, the Nasdaq actually was pretty good price action, but it still looks weak. And again, if I look at the Dow down 1%, it's just not looking too good. What is scaring the market at the moment is a lot of these banks, they've invested into a lot of bonds at very, very low percentages, like 1%. It's starting to cause a lot of issues internally in the system. And there's talk today in the news about Credit Suisse problems. The share price has gone down. Possibly the bank could go down. We don't know yet. Is this, my question to you, is this another 2008?
No. And I'll tell you why in a second, but I don't think Credit Suisse will go down, because this morning I saw the regulators in Switzerland saying, we've got their back. Right? So they have, I think, probably again, like the Fed, well, like the Americans did, they are probably averting any contagion, any issues. But I think it's all, yes, there's an issue, underlying issue with the interest going up, and it's bringing to the fore some banks' weaknesses of maybe not very well run, right? Or they've overextended themselves in some way, and obviously some funding issues in there. Generally speaking, a lot of the banks, the bigger banks, are fine. I don't think there's a problem with them, right? It's the smaller banks, the banks that may be more of the wild west type stuff that are looking quite vulnerable, like we've seen with SVB and some of the other stuff. And you know, that's a function of obviously the rising interest rates in such a short space of time, I suppose. But at the end of the day, remember, the GFC time was time of exuberance, time of no regulations whatsoever in the financial sector. Now we've got much stringent, more, a regulatory regime where that's really a lot of the bigger banks are hopefully in a much better space than they used to be. So I just don't see the GFC being repeated, but I can see certainly a few more issues popping up, right? And I can see maybe some contagion spreading, maybe some of these shorters are loving this action because, it sort of works on a herd mentality, the panic that spreads from one stock to another, to a region, to whatever. So I can see that happening, but I don't think that we're going to see that systemic failure that we've seen back in GFC. But we're going to see, Dave, a lot of volatility. I'd say that's what's going to happen right now. And unfortunately, we're affected here in Australia because there's a problem here. We've got a very heavy ASX to financials, right? And we've got banks, which which we talk about it, but I think there's a great opportunity in some of these banks now to get a dividend stock if you need one. And of course, we've got also heavy in resources, which a lot of these issues that are happening globally now are affecting their commodity prices. I'm seeing them coming off, which is good. Inflation, we'll talk about it in a sec as well. So BHP, Rio are getting smashed. That's why we're looking pretty sick compared to, say, America.
So you're seeing a lot of this issue with the banks. Could be a lot of positives, and it could do a lot of dirty work for the RBA. It could do a lot of dirty work for the Fed. Now, Wolf. So they say blood in the streets. Where are the opportunities? Because the markets just could be tough. It could be volatile, but good stories that are paying good dividends, opportunities there. And can we look at we don't often look at them as dividend plays, but is this a time to start looking at Australian banks paying a decent?
Well, we don't look at it normally because they're normally like boring and maybe just too expensive. But now after this sell-off, yes, let's look at them as a dividend plays. I think if there's ever a time to look at banks as dividend plays, you look at them in a time of crisis. That's probably where you're going to make the most money out of them, right? So I suppose maybe we're the start of it. I'm not sure, but we are seeing them getting sold off significantly. So that's the time to start sort of going, okay, where would I be prepared to buy some of these banks as a dividend play? historically speaking, Dave? And maybe, you can help us out with the charts here.
Well, let's go for the banks, and because we can always leave a dirty bid on there, right? Or like a hopeful bid at when if you're looking at ANZ, it's tended, it has gone down to 15 twice before, but it's tended to sort of really range trade, I think somewhere between that sort of 20 and 30 level. So one would think, if you look at ANZ, if you got some near that $20 mark, if you had that long-term view, it would be some pretty good buying, Wolf.
Yeah, I'd say so. I think if you get picked up when you're doing well, I think.
Yeah, let's have a look at NAB, because again, these are, there's certainly stories that are not, they don't look, there's no growth in these stories for 20 years, but they do range trade. And again, NAB is actually holding up reasonably well, but I reckon, again, if this goes on, if you look at maybe, I think if you could get some NAB or anywhere in that sort of low 20s, you'd be very, very happy, Wolf.
Yeah, I think so. And look, I think probably that one's doesn't give me enough incentive at the moment, like the ANZ, right? Where ANZ is looking pretty sick. This one's actually not too bad.
Could you call out that what dividends we're getting on these banks?
Yeah, I'm just looking at it right now, actually. So ANZ was almost 9%, right?
Yeah.
So NAB at the moment, I'm looking at let me see, 7.6. So I think that's why ANZ looking much more attractive for me, right? From that point of view. So let's look at CBA as the next one.
And again, it's been, CBA has been most probably our best performing sort of out of the big four banks over the last 20 years, where it has had
some growth in there, right? You can see the charts much better than the rest, right?
Yeah, where you have actually doubled your money over a period of time.
But maybe around the $82 mark you'd be looking at, right? Somewhere there.
Yeah, definitely. Where it's sort of come down there before. It's played with those sort of levels with sort of smaller pullbacks, hasn't it?
Yeah.
And again, it doesn't pay you quite as big a dividend at the moment as
6.5 for CBA.
And what about Westpac?
Let's have a look at Westpac. And Westpac is paying you 8.3. And again, I don't, if I look at the numbers, I think ANZ looks the most attractive dividend-wise and cheapness-wise. So Westpac is trading on 14 times. I think ANZ was trading on about 9.
All right, so we sort of possibly really found an opportunity here. Would you look at something like ANZ and say, well, maybe it's nibble away time?
Maybe. I mean, you could make a case for ANZ right now to have a little nibble, and maybe if it goes to 20, you have another nibble, right? Because like I said, if you look at the long-term dividends, you want to buy it on the cyclical lows.
Right. So no, it looks very, very, very good. So I think yeah, I mean, you could nibble a little bit. If it goes lower, nibble a little way more. I think at 9%, that's fully grossed, right? That's grossed.
Yes, that's right. That's fully grossed.
I mean, it's very attractive, very attractive. So ANZ, we're starting to really notice an opportunity with ANZ at the moment.
Yeah.
Likewise, I'd like to go for some of other sort of ones that we got on Equity Story as dividend plays.
Okay. The official dividend plays that we've got on our website. So let's have a look at them.
Right. So you've got Suncorp, which is talk on this split, Wolf, but it's come back down to trend in that longer term. What are we getting on Suncorp right now?
We're looking at about 6% fully grossed up.
Okay. So
decent. The split was actually probably going to be a positive. So I'd be probably maybe having a first nibble around the blue line.
Right. What about Metcash?
All right, let's have a look at Metcash. And another one that's still trading above. So they're still pretty comfortable with this. Remember, we're looking at monthlies on these. This one's 8.5 day, which is very, very attractive. And yeah, I'm liking this too. I'll probably be nibbling around these levels.
Well, again, starting to look at two stories that are really standing out for me so far, ANZ and Metcash. What are we looking at on BHP at the moment? Still,
I mean, I'll still be probably holding for the dividends on this one, even though you're probably going to get, I think you just got paid out on that.
Iron ore is the only thing that's actually holding up at the moment. It's a big part of BHP.
Exactly.
So
exactly. And you know what? Even if it halves its dividend, because we're expecting that the earnings will probably fall off a cliff And I think a lot of the brokers saying it will fall off a cliff. So let's say from 12% dividend to 6%, still very attractive, right? So I'll still be probably having a nibble around the $41, $42 mark.
All right, let's go to Macquarie.
Mhm.
Because again, it definitely looks like it coming back down to trend, maybe down to that 161.
Mhm.
I think they're about 4.2% now.
Yeah.
But if you could get them around 1.61, this is a story that you like. It's a good growth story.
Yep.
You know, getting a nice div of 5-6% out of Macquarie with growth over that long term opportunity, Knox Wolf.
Look, I think this is again throwing the baby out with the bathwater. I think if I can pick it up around 160, I'd be doing pretty well.
Oh, all right, okay. Let me have a look at CLW. So Charter Hall, anywhere around that $4.
Yep, I'm happy with that. You know, it's a fairly steady real estate investment trust. So I don't have any issues with that whatsoever. Very well diversified, 6.5% yield. Yeah, I'm okay with it.
So down near that 4 would be giving what, closer to 7.5.
Yeah.
PPE, so people infrastructure.
Yeah, so this is a smaller one I've put in there. You know, obviously a little bit risky, which we've put on there, marked it on our website that is much more riskier. But you know what, giving it almost 7%, PE of 10, still growing. They've been looking at they've been actually said on one of the presentations, they said we are looking to do something to alleviate this ridiculous share price action because we just think there's much more value in it. So maybe they want to sell themselves to someone.
Okay, so interesting. Good company, strong announcement.
Yep.
You know, it's actually come down to recent lows now. You know, if it breaks its low, it could go low in this environment. It could start hovering down the mid 2s or low 2s, but possibly opportunity knocks. Yeah,
since we're looking at it on a monthly, I'm going to give that to the month to see where it finishes off. Even if it goes down to 250, I'm still okay because the dividend's so high at 7%. I'm all right.
All right, let's have a look at ORA. So again, you know, what an amazing chart. So again, 5% opportunity.
Yep, cheap. You know, historically cheap. Good dividend yield of 5%. Great management. Of course, you can see that they've reversed course for the share price because of, you know, they've just reiterated that they're doing okay in a very difficult market. So the market's still okay with it. So we're going to hold it for the moment.
You've got SHL. Wolf, actually not a bad looking monthly chart on SHL. And just in this environment, healthcare holding up, not looking too bad. That's not a big dividend payer.
So, no, for about 4.5% is actually pretty good for Sonic. It doesn't usually have that sort of high dividend payouts because it normally trades on much higher multiples. So I think, you know, again, there's an opportunity right there for a really quality story. Look at the chart over the last 20 years, Dave. It's actually been excellent, right?
Yeah, no, it has.
It's only just the pandemic that's really caused a bit of ruckus. And it's now getting back to its normal trend that we used to have. So yeah, I'm happy to take that 4.5%. And, you know, within the next 5 to 10 years, you've got to take that view with these sort of stocks. You're probably going to get that 4 to 5% dividend yield every single year.
Okay. You've got 9 NEC. It's again very sideways, but the dividend payer, it's only trading on P of 11. It's not expensive. Dividend yield of 7.53. I think
I've got 10% grossed up.
Grossed up 10%. Pretty good, right? So
yeah, so I left it on there, you know, because it's still a fairly, for me, defensive, right? Everyone watches TV, so there's going to be advertising, and they're still going to be paying out quite a nice dividend. But you know, it could be on a chopping block if maybe drops down below that 150, maybe. But for the moment, I'm still all right.
Okay. West Farmers. You know, if you look at a long-term chart, it's holding up reasonably well.
Yeah.
They're giving us 3.74%. Obviously, gross up a little bit more.
5.5.
I think if this, you know, if came back down to that 40 level, it'd be load up in this times, correct?
No, absolutely. If I could get it at 40, even the fund would be buying.
All right. Now, what about IPL? Because this is a company that had a superb announcement, and the market has really not embraced it at all, Wolf. But it's giving I think a grossed up div now of about 11%.
12.
12. It's trading on a P of 6.
Yeah.
I'm liking this, and I'm actually going to lift this up with the ones I'm really liking at the moment. So
Okay.
I'm sort of getting, you go through the stocks and you're looking at like ANZ, IPL, Metcash, right? Thank you very, very much. There's a nice little group of stocks there giving me a very handsome around 8.5%, 9% return.
They're giving you almost 10% grossed up dividend yield of the three.
I know. So just an interesting three stocks there, isn't it?
Agree.
Okay. IGL. How's IGL cooking for? Because obviously a strong chart. Little bit more of a small cap. This is in one of your. This is one of your dividend.
Yeah, this is actually in the portfolio of the fund, Dave, but it's not because of the dividends. I'm not getting the dividends, but because it's of its growth. So you're getting a dividend with growth here. So not a 10% grossed up. Yeah, I'm liking this.
Right. Listen, I think it's well worth everyone having a look at these stocks. And it's good to see you've got other stories like SXE, IGL, LAU, CLX, XRF, BRI. These are some small cap dividend payers, not expensive companies, but actually, Wolf, they're holding up really well in this market.
They are.
There's a big, people are looking for value. They're looking for dividends, and there's some there. And I think, you know what? In this environment, ANZ, IPL, Metcash, I think three real standouts. And certainly I'd put Macquarie in there if we could get Macquarie a little bit cheaper.
Yeah. But I'll tell you what, in this current market where we've got this sell-off in the banks, which really has got nothing to do with Australian banks, should be going. I'll take one of these at least.
Yeah, no, absolutely, definitely. Now, all right, Wolf, great stuff. Now we didn't have a look at we've had a look at some dividend players. There were some stories that announced today. SRG.
Yep.
I'll just go back to a weekly chart, which was pretty, holding up. Difficult market, but holding up reasonably well.
Yep.
Again, we've got more cybersecurity attacks.
Yeah.
IPH is down and LFS is in a trading halt. So again, what does that mean? Cybersecurity and finding good cybersecurity companies is a go-to. Get DSC on your watch list.
Holding on for dear life, baby. Come on.
Well, opportunity knocks if it goes low.
Yes,
right?
I agree.
You got the Promedicus. You got one of the directors. I think one of the original.
All of them are selling.
Yeah, so take a warning, but the market's actually holding up very, very well. TLX came out with a very strong announcement. Wolfie, I thought it would have done a bit better.
Yeah, I think the market really nervous, but and then look, the announcement wasn't anything ball tearing. It was just another FDA approval to continuation of what they've already got. So they just give them more scope to pursue its Illuccix, which is good. So it's a positive, but I think that was pretty expected. I still like this in that space of healthcare. So for me, one of the more interesting stories for sure on the ASX right now. And
for those people who like those resource plays, those sort of high risk, this DYM is looking interesting because it was only trading about 6-7 million market cap. Just got some good drill results.
Bring him up. Let's have a look at it.
Yeah.
So we can go through it.
So I know they're up 60%, but what are they now? 10 million market cap?
Yep.
It's not a game breaker, is it?
No.
And sorry, excuse me, I'll just bring up this high grade.
So let's have a look at this announcement. And basically there's three things to look at, right? I suppose the three commandments, so to speak, when you look at the depth, the grades, and the thicknesses of these things, right? So we've got really 2 out of 3. Which is pretty good for a small 6 million market cap company. That's excellent. That's probably why it's driving it up, and it can go further if they can keep delivering this sort of results. So it's look at it from 50 meters, which is pretty thick for nickel, right? At 1.86, that's almost getting there. Anything over probably 2%, you're starting looking at high grade, right? So that's almost there. And you're looking for 27. That's very shallow. That's almost from surface, pretty much. So that's very nice. They just need more of that, right? That's why it's gone up on the back of that. And they are in a very, first of all, in Australia, in a nickel producing region, district. So one to watch, one to see if they can come up with more.
Well, for that, yeah, these ones in blue are the ones that they've just done. They had some previous sort of drill results here, which wasn't too
These are
bad.
historical. So the MRC ones are from Mincor back in the day. So these are all historical. So they were following these historical drill holes up with their own, and they're confirming them, right? That there's some great nickel in there. Let's keep drilling and see if we can come up with some sort of a resource where maybe they can start mining this, because it's so shallow. I mean, that's the beauty about this. So normally, these days, nickel in Australia, you got to probably dig down 300, 400, 500 meters down.
And I love the way they've presumed this is full of nickel here, right?
Well,
it could actually be nothing there, right? So this is why
exactly, especially like the one you see, the one on the right, there was nothing there.
So
001.
So I presume they're going to be putting a big shoot down here to have a look at if their theory is correct. Okay, so you've got to love the way they make these drawings. Absolutely brilliant, isn't it?
The thing is, a lot of people just can't understand what they're showing there. But look, it's still decent. So like I said, because it's shallow, they can maybe following it the other way, right? Instead of going to the sides, go a long strike and see what they can come up with.
So when you're looking at this and you're looking at this, can this be I mean, nickel's very, very different in sort of understanding nickel ore bodies, Wolf.
Yeah,
they are these like little clumps, aren't they?
Yeah, well, because usually it's associated in Australia with lava flows, right? So you've got lava flows, you've got channel, little tubes going through undergrounds. Back in there when the volcanoes were going, they had lava flows that sort of solidified. Minerals were deposited on the bottom of these sort of lava flows. And now we're exploring these up, and there's a lot of mines are based on these lava flows, and this is probably one of them as well. So they're going to follow these lava flows and see whether these channels keep coming up with this nickel.
All right, now they've only just listed, so I presume they've got a little bit of cash.
Yep, they would.
Most probably they might. They've had a good move. Wouldn't be surprised maybe if they raise a little bit more. That's what you just got to be careful about.
Yeah, but saying that, I think because it's so cheap, still 10 million market cap, I think this is still a good prime candidate to have more FOMO in this, right? That's how I'd look at it. The question is whether you buy it now, whether you wait and read about it and see what else other drilling holes they're going to come up with. So if there's still more stuff on the horizon where they're going to some more results coming through next 2 or 3 weeks, you probably take a position. If there isn't anything there, they have to regroup and say, okay, we got to start a new drilling campaign. Maybe in 3 or more. Maybe you just wait till it settles down and you go again, right?
Yeah, definitely. So would you buy a bit of this? And
look, if I'm a trader of these sort of stories, it definitely would be on my watch list, and maybe I'd look. Maybe what I'd do is use that 60-minute chart, Dave, to sort of trade this sort of stock, right? So if you're looking at a daily trader type stuff, then I'd be probably looking at the short-term type stuff. Follow the FOMOs. If the FOMOs are getting out, you're getting out. If the FOMOs are still there, you'd be probably trading this, because, like I said, it's cheap. It could easily come, have some more legs in this, so you can follow it. I'm just going to have a quick look at the actual management of this. So just give me a sec. I want to see if there's some good names in there. If there's good names in there, I'd probably tend to follow it a bit more. So let's just have a look who's in this. Hang on a sec. I'm going to have a look at. All right, interactive. No, I don't know any of these people, so I'm sort of letting the management have a neutral standing for me. But other than that, it's a pretty small one, so you'd think it's got more legs to it. You'd think.
And do you know what? I think they raised 7 million. I think they've got a little bit of cash still. So
yeah, oh, for sure.
Yeah, so I think there'll be a lot more drilling, hopefully, before they raise. So yeah, interesting story, Wolf. So thank you very much for that. On that note, Wolf, opportunity knocks on dividend stocks. Any short-term trading is going to be tough because these markets could potentially go a lot lower over the next few weeks if this banking crisis gets worse. On that note, Wolfie, thank you very much, and stay on the line, Wolf. I've got to call you back on something else in a second. Thank you.
See you guys.
Bye.
Bye.